Let's analyze NIO's stock, discussing what is happening and what happened over the past week. We will also examine volatility, the volatility smile, and the support and resistance levels of the options. I will provide a market forecast for the upcoming week and include a strategy that allows for profit in any market condition. Starting with the stock, NIO has dropped by 10% over the past week. This significant decline is bringing the stock close to its April 2024 lows. Let's discuss the volatility now. As we can see, volatility remains high, especially for the expiration date. For the near-term expiration dates, volatility dropped after the report, but remains between 70% and 80%. This means the company is still highly volatile. Now, let's look at the volatility smile. Options can indicate the short-term and mid-term movements of the stock. The volatility smile for the nearer expiration dates points to both upward and downward movements of the stock. This suggests that investors are considering both the possibility of the stock rising and falling. However, for the longer-term expiration dates, the volatility for upward movements does not increase, but it does increase for downward movements. This means put options are more expensive than call options. In the longer term, investors are anticipating a greater likelihood of a significant decline, which is why put options are becoming more expensive. This is a normal situation because investors and traders hedge their assets by purchasing put options. Now, let's look at historical and implied volatility. The historical volatility is shown by the gray line and the implied volatility by the white line. Currently, these volatilities are diverging. The implied volatility is higher than its historical values, indicating it might decrease. I always say that it's possible to trade not only the underlying asset, such as the stock itself, but also the volatility. Trading the stock is much more complicated than trading the volatility because we do not know where the stock will go. We can predict where volatility will go because it tends to revert to its historical levels, giving us a reference point. This is a significant advantage when trading with volatility. I can demonstrate an example of how to do this using artificial intelligence to help calculate and develop a strategy. Even if you don't know how options and derivatives work, AI can assist in strategy formulation. We anticipate a drop in volatility and are provided with several strategies, each with different probabilities of profit. One such strategy is a short strangle. We sell a put option with a $4 strike price for August and sell a call option with a $5 strike price for August. This is a classic strategy, and the profit-loss profile looks like this. We can compare it with other strategies, but there's nothing unusual here. Again, this is just an example. I do not recommend trading solely based on AI. It's merely a tool you should understand how options and derivatives work. Now let's look at the support levels. We see a massive wall of call options at $5 and $4.50. This represents significant resistance that will likely keep the stock from rising further for some time. The large resistance levels are at $4.50, $4. Regarding put options, the volumes are much smaller. A significant volume is concentrated at the $4 level, indicating resistance at this level. I predict that in the short term, the stock might oscillate between these values. To overcome these support and resistance levels, some event must occur. Returning to the stock, here's what is happening. I always remind myself of the philosophy that I don't know where the stock will go and can't predict price movements. The main goal is competent position management. My task is to build a portfolio that can profit in any scenario. Here is one of the strategies I have developed. As we can see, if the stock starts to rise significantly, we begin to profit. This strategy involves buying both put and call options. Thus, if the stock starts to drop significantly, we also profit. Here's how it looks, but I would not recommend opening this strategy without careful management. This strategy is quite complex and requires active management, buying and selling options at the right moments to avoid losses. This is how I trade. If the stock rises significantly, we profit. And if it drops significantly, we also profit. This is the secret. Now, let's look at the market forecast. For instance, if we consider mid-August 2024, the highest probability is that the stock will be between $4 and $5. There is also a significant probability that the stock will be between $3 and $4. This suggests that the market predicts the stock might fall further, which is not very positive. However, the market incorporates all available information about news, options, and derivatives. I would not advise going against the market. If we look at November, the situation is similar. The market predicts a range between $3 and $5. Nonetheless, the company is interesting and has potential. We need to wait for a catalyst because currently it is unprofitable. We need news and information. I will certainly share any important news. If there is a trend towards electric vehicles, the company could grow significantly. If it continues to develop and shows good financial results, we could eventually reach historical highs. However, this will take years, not weeks or months. So if you are investing with a horizon of 3 to 5 years, some tangible results may appear which is definitely positive. Therefore, if you are aiming for a stock price of, say, $50 or $40, it doesn't really matter if you buy it at $5 or $4. The difference is significant, of course, but if this is the next Tesla, then there is certainly a huge potential here. However, the company is currently unprofitable, and we need to face reality. The most important thing is for it to overcome its difficulties, continue to develop, and then it has great growth potential. In the meantime, you can use options and derivatives to manage your positions wisely and profit from this company, given its high volatility. I also want to remind you that I have launched a new experiment. I have already released the first video, which is a portfolio built from scratch, where I explain which stock I bought and why. I detail how to properly manage a portfolio using derivatives based on options. I recommend you watch it, and if you have any questions, feel free to leave them in the comments. Good luck to everyone.